Welcome to Accounting in Focus. In this video, we are going to look at sales for a merchandiser. A merchandiser is a company that sells a product to its customer. Therefore, we have to worry about inventory. There are two methods a business could use. They could use the periodic method or the perpetual method. The perpetual method, perpetual means, let me make sure I got the right color here. Perpetual means always. So under the perpetual method, we are always adjusting inventory. The periodic method, think about the word periodic, right? It means periodically. So inventory adjusted at the end of the period, which usually means at the end of the year. Okay, so under periodic, inventory is only adjusted at the end of the period. Perpetual, we are always adjusting inventory. Okay, so you got to kind of think in that mindset when you're doing your journal entries. So the periodic journal entries are actually really easy. They're very similar to the journal entries we had done before when we were dealing with a company that did not sell a product, that sold a service instead. So let's actually do periodic first, and we'll run through these three entries and see what they look like. So we know that this is a sales transaction because it says on 4/15 ABC Company sold. They sold $7,500 worth of inventory to a customer. Terms 310 net 30. What does that mean? Well, if we have terms, that means the customer did not pay cash, so it's on account. Okay, and we're dealing with on account with a customer. So when you see on account with a customer, let me put my date in here. You should be thinking accounts receivable because we are going to receive that money. Okay, so accounts receivable. And what does that mean, terms 310 net 30? Well, what that means is that we've got 10 days to pay. If we pay within that 10 days, we get a 3% discount. Okay, so if you pay by 425, or if the customer pays by 425, the customer gets a 3% discount. The customer has 30 days to pay the net amount. Okay, so if the customer does not pay by 425, the customer could pay by 515 and get zero discount. It's not really clear. We need a little bit more spread there. There we go. Zero discount. If they pay after 515, then that means we're probably going to charge them a finance charge. Okay, so we're either going to charge them interest or a late fee or something like that. Okay, so what we're trying to do is we're trying to encourage customers to pay quickly. So we've got a sales transaction with terms, which means accounts receivable. And what's my other account? Well, I sold something, right? So I sold inventory. So that means I've got sales. Okay, which one's my debit? I've got accounts receivable, which is an asset. I've got sales, which is a revenue account. My accounts receivable is increasing. The customer owes me $7,500 more than they did before they bought the inventory. So I'm going to debit accounts receivable. And then my sales are also increasing. Sales or revenue account. So credit $7,500. Okay, now because we said periodic, inventory is adjusted at the end of the period. We don't do anything having to do with inventory. Okay, because that's going to take care of itself later. So now Let's look at 419. Received a return from the sale on 415, which is the one we just recorded, in the amount of $800 because the wrong product was shipped. The goods return cost $350. Okay, we're not concerned with what the goods cost because remember, adjusting inventory at the end of the period. So we received a return. Okay, so what does that mean? So you should be thinking, okay, let's see, it's a sale. So we're dealing with sales, returns, and allowances. So if you watch the video on purchasing, which if you haven't seen that video, you might want to go back and watch that one. We had purchase returns and allowances for when we're purchasing things. When we sell things, we have sales returns and allowances. So if the customer returns something that lowers my sales, we're doing that through sales returns and allowances. What happens to the balance in their accounts receivable? Do they still owe me $7,500? Nope, they owe me $800 less. So accounts receivable is the other account. All right, so now let's see debits and credits. Well, sales returns and allowances is a contra revenue account, which means it acts opposite to sales. Okay, so sales returns and allowances, if the normal balance in sales is a credit, then that means the normal balance in this contra account, sales returns and allowances, would be a debit. So I'm going to debit sales returns and allowances 800, and my accounts receivable is decreasing, right? The customer owes less money than they did before. So I'm going to credit accounts receivable for 800. Okay, and that's it. We don't have to do anything with inventory because we're doing periodic method. And then on 424, ABC receives the balance due on the account. Okay, now don't forget we had terms. The terms were 310 net 30. So let's look back. So if the customer pays before 425, on or before 425, they get a 3% discount. So this does qualify for the discount. Okay, so you might want to make yourself a little note. Discount. Like a discount double check, right? Boom, there you go. Okay, so, all right. So that means they're not going to pay us the full amount due, but let's try to see what that looks like. Well, we know they're going to pay us cash. We like getting paid in cash. We also know that they're paying down their accounts receivable. It says that receives the balance due on the account. Accounts receivable. Okay, so now let's figure out these two. So how much is my accounts receivable? Let me pop down here and get my calculator. Okay, so, all right, customer bought $7,500 worth of inventory. Then they returned 800, so minus 800. That is 6,700. Okay, so now is that going to be a debit or a credit in accounts receivable? We debit it when it went up, we credit when it goes down, so we're going to credit. There goes my calculator, 6,700. Okay, now how much cash are we going to receive? Well, remember we said they're getting that discount, so we're not going to receive all of the money. We're going to receive 6,700 minus 3%, or we're going to receive 97% of the money. So I'm going to multiply this by 0.97. Okay, so instead of saying the amount times 3% and then 6,700 minus that amount, I'm just going to do 97% because that's how much we're going to get paid. So we're going to get $6,499. So that is a $201 discount. Okay, now if you can think back to purchases, When we were doing purchases on the periodic method where we had purchases and purchase returns and allowances, what did we call the account when we had a discount? Well, when it was a purchase, we called it purchase discounts. So if it's a sale, what do you think it's called? Sales discounts. I heard somebody yell it out back there. Sales discounts. Okay, those are my entries under periodic. So notice we didn't touch inventory at all, right? All we dealt with was accounts receivable, sales, sales returns and allowances, cash, sales discounts. Okay? So this is very similar to what we've always done, right? We've recorded sales and accounts receivable. We've recorded payments of cash. Okay? So let's look at what perpetual would look like. And I'll do perpetual in a different color. How about that? All right, let's look at 415. And I'm going to do my DR and my CR, debit and credit. Okay, so let's see what we have here. So my sale, okay, the first part of the sale is going to look exactly the same. Accounts receivable and sales. Okay, and let's put in our numbers because we already know what the numbers are going to be. 7,500 and 7,500. Now, remember, we are always adjusting inventory. So did my inventory change? What did I sell? I sold inventory, right? And the goods sold cost 4,700. So my inventory is changing. Okay, what do we call it when we sell inventory? Well, the goods sold cost, that's kind of similar to the name. The name we're going to use is called cost of goods sold. Cost of goods sold. Okay, that's the account we use when we sell something. Okay, that's the amount that goes on our income statement. So now, how much is my inventory changing? Well, the cost was 4,700 and my inventory is going down, so we're going to credit 4,700. And my cost of goods sold, we're going to debit 4,700. Okay, so it's almost like doing two separate entries, right? We're doing one for the sale, and then we're doing another one for what's going on with the inventory. Okay, so that's what you have to do with perpetual. Okay, you're always adjusting inventory if inventory is changing. So now let's look at 419. On 419, we've got that return. So we're going to record the first part exactly the same way as we did for periodic. Sales returns and allowances and accounts receivable. So that's exactly the same as what we did before. Put in my 800 and my 800. Okay. How much? Now, it was the wrong product was shipped. Okay, so the product's not damaged, it was just the wrong product. The goods returned cost $350. So what's happening? Those are going to go back into inventory. So my inventory is going up and my cost of goods sold is going down. Okay, so my inventory is going to go up $350 and my cost of goods sold is decreasing $350. Okay, so again, it's like two separate transactions. The sale, or I'm sorry, the return and the adjustment to accounts receivable, and then the inventory. Now let's look at 424. Okay, first thing we need to ask ourselves, is there any inventory moving? Well, all that's happening here is that we're receiving money, right? Receiving the balance due, so receiving money to pay off the balance. So that means that no, there's no inventory moving. So this entry is exactly the same as the entry we did for periodic. Cash, accounts receivable, and sales discounts. Okay, so notice when there's no inventory moving, the entries are exactly the same. Okay, there's no difference. And the discount is still 201. Okay, so when you're reviewing this material, remember that perpetual you have to be thinking, is my inventory moving? If it is, you almost have to do two different journal entries, one to record the sale and one to record the movement of the inventory. Okay, under periodic, we never record the movement of inventory because we record it at the end. Okay, under periodic, think about how we calculate. Okay, think about how we calculate our cost of goods sold. It's beginning inventory plus purchases. That equals goods available for sale minus ending inventory gives me, and hopefully you guys see this, cost of goods sold. Okay, so in the periodic method, we actually calculate cost of goods sold, right, using beginning inventory plus purchases, then subtract your ending inventory. That gives us cost of goods sold. Where perpetual, we are constantly updating the balance, so we don't have to worry about this calculation. Okay, this calculation that you probably learned in your class is only used in periodic.